Welcome back to Ask an Advisor, where we go deeper on all things investing. I'm Krista DiBiase, here with the Wes Moss.
Hi, Krista.
Great to be with you again,
Great to be
Wes. Very much looking forward to today's show. I understand you're going to talk about, first of all, can we withdraw 5% a year from our retirement accounts?
5%?
People are like, no way
talk about
listening right now.
We're going to talk about that.
And then also, what happens 1 year after we have a market correction?
We got our first official correction of 2025, down 10%. And the question is, where do we go from here? Historically, what do markets look like?
And I have a lot of questions for you. If you want to ask a question to either Wes or Clark, you can go to clark.com/ask, and Clark will be back tomorrow with a brand new show. So let's go ahead and start with that 5% rule.
So it's a financial heresy, 5%. That's a crazy number. And this is the great debate within financial planning. And we'll never know the exact number today because we don't know what the world's going to throw at us. We don't know how long we're going to live. We don't know what our rate of return will be over the course of our retirement or at any point in any period of time. Wouldn't it be nice to know exactly what our rate of return would be, what inflation will be? But so when we're doing financial planning, we've got a dozen at least really important variables that make up a cash flow plan, a long-term plan to make sure that we're safely not ever worrying about running out of money. It's still a top fear in the United States. Running out of money is a very scary thought for anyone. But we go through this long period of time, 20, 30 years 40 years of saving. But if you were to boil down all those variables when you're running a financial plan, what really it comes down to one, I would say the most important variable is your rate of withdrawal. Because the rate of withdrawal is saying, okay, how much of the savings that I'd spent 30, 40 years accumulating, how much can I use in any given year? So, which means how much can I spend? What's my standard of living going to be when I'm in retirement? So that is the crux of all financial planning. What is for the most part been agreed upon is this 4% rate of withdrawal rate. William Bengen, the godfather of the 4% rule, ran a bunch of studies, ran market studies all the way back to the Depression and looked at different withdrawal rates. Because what we're all trying to do, and I think of it this way, is max out without running out. Max out what we're withdrawing from our portfolios without having the fear of that going down to zero at some point when we still have a lot of years left on this planet. So there's got to be some sort of optimal number. Now, anytime either market returns look as though they're not going to be good, anytime interest rates are low, because part of most people's withdrawal strategy needs to be a balanced portfolio. The 4% rule says you've got to have at least 50% in equities. That's the engine that allows us to increase our spending for inflation over time. So if we assume that Bengen's original work, which I've redone his study over and over and over again and kind of brought it up into the 2020s, and it still works, and I actually call it the 4% plus rule, but this past fall, Barron's made a big splash and came out with an article that said, you may be able to do, or really they said, you can do 5%. You can have a 5% withdrawal rate. Now, the counter to that, and there's several financial folks in the financial planning community that'll come out and say, no. If you really want to be safe, just pull out 2.5%, or that's your max withdrawal rate. And when that starts to happen, that kind of frustrates me because, of course, if you barely take any of your savings out over time, of course you're not going to run out. But then what's the point of the savings? Mm-hmm. So there's got to be this happy medium. So Barron's comes out and says 5%. You can do that. Well, how do they get to that point? One, they cite that recently some of the big Wall Street firms have come out and said because interest rates were higher at the end of last year, that means your bond should produce more over time. So those expectations are higher. The equity market should do 8% a year according to, I think it was JP Morgan or Morgan Stanley, one of the Wall Street firms. So those return assumptions are pretty healthy. And if both sides of your equation, stocks and bonds, both do well then maybe you can pull out more money. The way Bengen said, and this is from a year or two ago, he said you can give yourself a retirement raise by adding in some small companies that typically have a higher rate of return over time. So he's suggested that 4% is even too low. So I wanted to go back and see what makes this possible. And we ran the numbers. So I'll look historically. Well, I'll share with our listeners and our viewers, what does it look like if we start out with 5% and withdraw 5% plus inflation every year over time? What's our probability of never running out of money? The first point in all of this, whether you subscribe to 4% or 4.5% or 5% or even higher, is about flexibility. Because in the real world, Krista, we don't turn on our financial spigot from our accounts and say, okay, I'm getting my 4.25%, and I'm going to perfectly ratchet that up exactly for CPI or inflation every single year until the end of time. That's just not how it works in real life. So flexibility is the key, meaning that we can look, we may go through a period of time where markets are really good and they're really strong and they're beyond our expectations. And you can say, gosh, I think I can take out a little bit more money, or we can go on an extra trip or two that I hadn't thought I could budget for. Same thing when we go through a protracted stretch of not great markets and really low interest rates. We want to be able to be flexible to say, well, maybe we spend a little bit less. That's the real world when it comes to managing your withdrawal rate. But what do the numbers say? And our team has run every single calculation that you can think of. 4% with different portfolio allocations, 5%. We've looked at 6%, which money does run out pretty quickly at a higher percentage rate, a higher percentage of stretches. That one I think is probably a little bit too aggressive. But if we're just looking at the numbers, and if we look at a 5% withdrawal rate, now what's interesting, if you look at 5%, your best opportunity to not run out at least for 30 years is actually looking at an all-stock portfolio. Now, a balanced portfolio works as well, but here are the numbers. If we're looking at a 30-year period of time, a 5% withdrawal rate plus inflation, using the same metrics of this rule, money still doesn't run out 83% of the time. So 8 out of 10 times, you turn on the 5% withdrawal rate, and this is going all the way back into 1927, and imagine you retired in any given year over that entire stretch of history. So 8 out of 10 times, 5% rule actually works based on history. Now, you're going to say, wait a minute, well, I don't want to go into retirement thinking, I got an 8 out of 10 chance that I'm going to be okay and not run out of money. So it is riskier, but that's where the flexibility comes in. And I think that if you start out with a higher percentage withdrawal rate, you just know you have to be flexible if things turn and we go through really rough stretches. However, here are the little more the scary numbers and why you may not want to subscribe to 5%. Is that if you go and look over that almost 100 years of data, you do have some rough outcomes. And the worst outcome is money ran out in 12 years. That's no good.
Wow.
The fifth worst outcome was that money ran out over 19 years. So, however, again, 83% of the time money lasted for 30 years plus, 80% of the time 35 years plus, and 79% greater than 40 years without running out of money. So the way I would look at it historically, looking at market data and making sure you had a portfolio that is now in this case, this was a 100% stock portfolio, which is where we typically over time get our best rates of return. I would say it's very possible to do, but it's just a riskier approach to take. If you go to a balanced portfolio, Krista, where you have 60% stocks and 40% bonds and you use a 5% withdrawal rate, it is still 83% of the time. It lasts 30 years plus. And then the percentages drop a little bit as you start making things last even longer. 35 years, it's only a 70% probability that it works. And a 45-year period, it's only a 55% probability that it works. So money does run out quicker, obviously, because we're starting at a higher withdrawal rate. So the key to me goes back to flexibility. I still believe 4% is a safer route to take, and it's trying to max out what you're withdrawing without running out. Those probabilities that's where you get into the 99% probability that you're not going to run out. So it's possible, it's just a little riskier path to take, and it's a debate, by the way, that will be never ending.
All right, we'll go to questions now. This came in from Chip in Texas. I'm an avid listener and love Clark's approach to saving and spending less than you make. My kids all have benefited from his sage advice. This is probably for Wes, and I love the new dedication
Now
to
it's
financial
definitely for Wes.
information. My wife is 2 years older than I am and will not earn the 40 quarters needed to get Social Security on her own. I'm not sure how to think about when to take Social Security. I think I've been concentrating too much on when she reaches 70 and I'm 68 that I should take Social Security. If she was my same age, I wouldn't have that thought. So, is it still worthwhile to take Social Security when I reach 70 to get my full amount and half of the 67 amount for the spousal benefit, or are there other considerations? Our parents lived long into their 90s, so I'm planning to pass the crossover points that seem to be in the 80s.
Longevity, Chip, God willing, and I pray that you also have lots of longevity. That's one of the things I think about every day, longevity. I pray for that every day.
Oh, yeah.
Longevity for all of us and everyone around me. So I'm with you on that, Chip. I would say this. When it comes to planning for Social Security, we hear a lot about maximizing Social Security. And that's easier to do because we know, well, it's not perfectly easy to do because we don't know how long we're going to live. But if you knew you're going to live into your 90s, Chip, then the best way to do this is just wait till 70 and then wait to take for you for 70. And then, because hopefully your wife has lots of longevity, she gets a full 50% of that, the highest number you can get. But really the way I think about Social Security is not about maximizing. It's about optimizing it, meaning that you want it to be the right fit for you and you want to start taking it in the right year. So to me, it's not about maximizing, it's optimizing for your particular financial situation. Now, in your case, and I'm keying in on this, if you're like your parents and you do live into your 80s and 90s, you got a long way to go. And meaning that if you do wait, you should have the years to make up with these now higher payments because you waited for the years that you didn't take Social Security. And if I would be leaning, I think the way you're thinking about this, she can't collect Social Security until you start taking your Social Security. And she'll get 50% of whatever you're getting if you wait till your FRA, the full retirement age. And it sounds like he's already there if he's 68. So sure, you could go ahead and take it. You hit your FRA, she should get 50% of that. But it's 50% of a lower number. So this goes back to, in this case, I would lean towards waiting till 70 because, first of all, those numbers get to be really significant. You wait till 70, and I don't know the exact number for you, Chip, but I've seen $3,000, $3,500, I've seen people get over $4,000 a month if they're waiting all the way to 70. And then you get half of that, so let's call it you get 4, she gets 2. You get $6,000 a month, which is really significant. And then the next benefit of waiting and having that higher number, if you do pass away first, she now assumes your higher payment. So the waiting then also benefits her almost as a little bit of an income insurance policy. So it's not the perfect and black and white right answer to say wait till 70. However, I would lean towards that, knowing the longevity in your family and the situation that your wife is not able to collect social. I'd be leaning towards waiting.
This came in from Andy in Idaho. Wes, a couple weeks ago, you suggested to a listener to spread out the Roth conversions over a number of years to minimize the balance in the tax-deferred accounts before RMDs kick in. Is that really the best way to go? Sure, depending on if you have other income streams, the RMD might increase the tax burden, but wouldn't it be a benefit to leave some funds in the tax-deferred accounts to be able to use the standard deduction for RMD conversion after the age of 73? And if so, how much should be left in the accounts?
Andy's not totally wrong in that thinking. Because if you really think about, so first of all, it's not, I still say yes, you want to spread out your Roth conversions. And it's still about taxes today versus taxes tomorrow. And yes, for a lot of people, RMDs, the required minimum money you have to take out of your IRAs, it does lift people's tax bracket because you're having to take out money. So practically, by the time you're 73, you not only have your Social Security and maybe a pension, and your RMDs, you're going to have a fair amount of money coming in. And usually you want to have most of your Roth conversions done by then, because now you're being forced to pull money out of your retirement accounts. Now, if you've done most of the job, think about it. If you only have $50,000 or $30,000 left in an IRA, by the time you're 73, your RMDs aren't going to be that much anyway. So it's not going to be a huge amount of income. So, and again, I'm going to couch this with a little caveat here, is that taxes are super complicated, and they're these rolling progressive tax brackets, and every bit of income you assume or receive in a year will it's not just a black and white calculation. It's a progressive and rolling calculation. So you've got to run the tax calculation, meet with your CPA, and speak with your tax advisor on this. But the way I look at this is, when you're doing a Roth conversion, you're creating income. And if you are creating income and it's still at a relatively low amount, then sure, your standard deduction could work. And I know of folks, I've sat with people that have done this in lower tax years. Let's say you're a student and you're not making any money, you're waiting before you really get employed. Well, you've got a pretty easy Roth conversion there, and your standard deduction can really offset a bunch of it. Now, you can't do $100,000 conversion, but if you're doing $15,000 and your standard deduction is $15,000, then sure, there's going to be a really big offset. So it's actually a good idea and a good thought. Though even when you get to 73, if you still have some converting left that you'd like to do, the standard deduction could help.
Okay, and Patrick in Massachusetts sent you this one. I get shares of my company's stock as part of my compensation. I'm not planning on keeping these as part of my investment portfolio, and I typically donate the shares. Does it make sense to wait and see at the end of the year if the shares are up and donate as they will have more value, or down and sell using capital losses to offset tax, then donate the cash equivalent? Or should I just donate regardless?
I think just donate regardless, because we don't know where we're going to be at the end of the year. So if you knew that, hey, I'm just going to wait till the end of the year when my shares are higher, well, then we would also we put all of our money into those shares if we really knew they were going to be higher. So that would also require a crystal ball, and if you've got one of those, I'd love to take a look. But he's right, and this is for anybody thinking about donating stock. If it's appreciated, so if you paid $10 for stock, and even if when you're getting stock from a company, you're still going to have a basis on this. Mm-hmm. And if it's higher, then you are in usually a better situation to donate that if you're looking to donate money, because you don't have to sell, pay taxes on the capital gain, and then donate the cash. You're allowed to donate the appreciated stock, and you get the deduction amount for the full value. Subject to, by the way, 30%. You can only do up to 30% of your adjusted gross income. So if you make $100,000 a year, the max you can do, if it's stock, is 30%, $30,000. The max you could do for cash is $60,000. So if you make $100,000, you can get a deduction up to $60,000. You can donate more, Krista. You want to give away more than that. So those are the parameters: 30% for stock, appreciated, 60% for cash. But he's totally right. You're right thinking about if the stock is lower today, or if you wait a couple months, then you don't have a capital gain event to sell it, and you can actually take the loss. And a loss is an asset because you can offset other gains. You could even, on your taxes, again, consult your tax advisor, but you can take up to $3,000 of a capital loss against, and you can use that on your taxes. So if it's down, you're better off selling it, donating the cash. If it's up, appreciated stock, better to do it that way. And we don't know where the stock is going. So I usually would just advise, if you know you're going to make the donation, then I would do that as soon as it is available to do. Okay.
So coming up straight ahead, you're going to talk about what happens a year after a correction in the market.
Let's talk about markets.
All right. We'll be right back.
Welcome back to Ask an Advisor. I'm Wes Moss here on the Clark Howard Show with Krista DeViaz. Hey there.
Hey, Wes.
Where are we going? Just right into it.
Let's get into it. What happens after a correction?
Let me ask you this question. The markets correct 10%. Scary, worries, tariffs, the Doge, what's happening to the economy, recession. What's your worry level when this happens? On a scale of 1 to 10, 10 freaked out, 1's just no care whatsoever. Love it.
I would say, because I've worked with Clark and I've known you for so long, I don't panic. I really don't panic.
What about down 20%?
I don't, because I still feel like I have a long view. I want to work for a long time, but I understand why people get very, very panicked.
Does your anxiety go up at all, or literally just stays flatline?
I'm pretty flatline with it, because I don't even look at my accounts when it's like this.
Okay.
I just try to steady as I go, as Clark has always, I've worked with Clark for almost 28 years, and he's taught me that, and I've seen a lot of ups and downs, and I just try to keep putting my money in every month and trust the process. Yes.
All right. Well, listen. So unlike Krista, if you have human emotion here, then you're good. And again, I think it's great, because really you've been educated from this, and you have a high level of conviction. And that's part of why educating and reading markets and market history, it really works. It helps to understand. Right? It's not that you don't have emotion, of course. It's that it doesn't bother you. But it bothers a lot of folks, and that's just called being human. It's just human emotion. It's not enjoyable to see your account value drop. The pain of loss is 4 times as impactful as the joy of gain. Right? So we win $100, we have a 2 on the excitement meter. We lose $100, we have a negative 8 on the pain meter. That's just how we're wired. So it's important to kind of understand that as we go through market corrections. And I think you guys have been really good here on the show of educating over all these years. So a lot of folks may be like, oh, a 10% correction, I get it. However, it does raise eyebrows, and it does worry people. And I know that because I get lots of emails about this anytime the market has almost any hiccup. And so we've had a full-blown correction. It's in the books as one of now probably 49 since we've had World War II. So we've had about almost 50 corrections of 10% or more since World War II. Happen a lot. And the question is not so much the 10%. It's more, hey, wait a minute, is this going to go to 20? Are we getting into a bear market? Or remember when we went through the early 2000s, right after the 99 stock market tech bubble, the S&P 500 went down almost 50%. Now that's tough. I think even you might get a little nervous about that.
Sure, okay. I would.
And then that happened again in the great financial crisis. We were down almost 50% for the S&P 500. Now it didn't last long when we got to that level, but those hurt. And so the natural question, I think, is, well, what happens normally when we do go down 10%? And if you pull statistics if you go all the way back to the 40s, we've had, call it now, these are statistics before the most recent correction, but statistically we've had 48 of them before this past one, and 75% of the time, Krista, it did not turn into a bear market. So 75% of the time, 3/4 of the time, it did not go to the 20% or worse mark. So to me, that's doesn't mean we're not going to continue to go further down. It just shows that most of the time, 10% corrections just don't turn into full-blown bear markets. So that's one data point I think it's interesting and important. Secondly, if you go back again, let's go back. This one goes back to the 1980s, and we've had 21 corrections since then. Well, where are returns 6 months later, a year later? And I think that's really instructive too. So there's 2 kinds of corrections. You get a correction that's not accompanied by a recession. So that's just general market fear, economy's still going, underlying it's still strong, but we're just nervous and maybe stocks are overvalued and they pull back. If you look at that type of pullback, then a year later, stock markets are up 12%. Up 12%, wow. 12 months later. Now, if you were to look at all
of the low?
From the minus 10% threshold. Okay, so once you go down 10 and you look at that level, we're up 11 to 12% a year later. So that's the data. We do recover.
I have to tell you also, Wes, just a note, like Clark always likes to say, well, when things are low, they're kind of on sale. And so you keep putting, dollar cost averaging, you put your money in, you're buying at a lower price. And I remember during a big correction when my kids were really little, I had some cash and I decided to put it in their 529 accounts.
When markets were down.
And it really benefited me over time, especially because my daughter went to a very expensive college.
The quote I remember, there's a quote I like about this period of time, which is about corrections, is that the stock market is the only store that people run to the exits when prices go down. Mm-hmm. Right? It's just, but our natural intuition is not that prices are on sale; it's that they're going to keep going lower. Mm-hmm. I think that's really the fear. Here's another. If we go back over economic history, we actually have not had a period of time where we've had 3 bear markets. So again, we're worried. Most people are. We're dealing with 10% correction, but is it going to get to a bear market? Is it going to get worse? And the reality is, over the past, going all the way back to the 50s. We have not had 3 minus 20% within 5 years. Mm. And so, again, it would be improbable because we had one in 2020. Mm-hmm. We had a bear market. Then we had another bear market in 2022. So to have another one here in 2025, again, history doesn't point to that. And then probably, Krista, I think which is the most practical part about looking at these corrections and why we don't want to sell out and go to cash. If you look over the course of stock market history, and you were to do a tiny little dot for every day, whether we're up or down, and you go back, you look at a 80 or 100-year period, almost every single time you find a big down day or a big heavy correction that happens quickly, it almost always lines up within days or weeks or certainly within months that we have a big snapback. Mm-hmm. So almost every really bad down day or down week is accompanied in close proximity by a really big up day. So that just goes to show that the speed of declines, and this was the fifth fastest 10% correction we've had in history. It really happened quickly, and I think that also worried people. But over the course of stock market history, the faster the decline, usually the faster recovery, which just goes to the fact that it's almost impossible to be able to time getting out and then getting right back in to get these snapbacks. So we can't really time it. It's almost impossible to do so. Mm-hmm. So we have to have your perspective, Krista, which is conviction that over time markets will do well because the American economy is hard to stop. I think of it as the army of American productivity. A, the army of American productivity doesn't panic, and B, it just keeps marching forward.
All right, now we'll go to some questions. This one came in from Sriram in Washington. Wes, this is a 3-parter, Wes.
Okay.
One,
you could truncate it, or is it going to?
Well, let me see. 1, what is your opinion about the S&P 500 being top-heavy? Top 20 stocks make up about 50% of the total value, which is unprecedented historically. How can investors protect their portfolio in this scenario? 2, is passive investing the reason for the top-heavy market? And he links to an article. And 3, do you expect the future stock market returns to be comparable to historical returns? How does the low Fed interest rate affect returns?
Okay, so there have been a lot of articles about this recently. So first of all, if you go back over the last couple of years, you're absolutely right that we've had more concentration in the top 10 and 20 names than we've seen historically. Now, it is not rare to have 20, 25% concentrated in the top 10 names. That has happened that's pretty normal because the S&P 500 is cap weighted. It's weighted by size, and the biggest companies at the top typically do take up 25%, the top, just those 10. What's happened is it's become even more concentrated. So that was a big story over the last couple of years that the mega cap companies are getting 30%, 32%. Where are we today? Almost 35%. Is it because of passive investing? I don't think it is. I can see how it might. You could make an argument that passive investing is pushing up the top 10 names. I don't think that's the case. I think that the companies that have emerged to be the biggest have got such incredibly strong businesses that investors have flocked to that. Now, it hasn't hurt that more people have been putting money into passive indexes and strategies that continue to feed that. But it's not that new of a phenomenon. I'd say it is even more so the case, concentration at the top. But again, a lot of that is because of the properties of the companies. The second thought here is that a problem? Mm-hmm. Is passive investing a problem? And is it creating this imbalance? And my opinion there is that it's important to know this, is that we think, oh, the S&P 500, it's super diversified, which it is. But is it that diversified when 35% of it or 50% is really only 20 names? So I think it is important for investors to know that and understand that. I don't think it's a problem. There is some commentary out there that it's creating a bubble that will take down the stock market. But if you look, and there's no perfect answer here, we have $30 trillion in investment assets in the U.S. and you could make the case that almost half of that is in some sort of passive vehicle. But there's $145 trillion in assets under management around the globe. And only about 15 trillion that's index fund passive here in the United States. So really that's only 10%, which means there are millions and millions of people and trades and trillions of dollars that are still active managers looking for price discovery. And we're getting to a price that investors are agreeing upon. I don't think the passive movement, which has been around now for 3 decades, I don't think that's creating a bubble necessarily. However, and this is a very important point, by only doing, let's call it the S&P 500, you should know that half of your money really isn't 20 stocks, which leads us to saying, okay, how do you diversify around that? The short answer here is it's super easy to do. There are hundreds and thousands of other options out there, other ETFs, other low-cost funds that are not indexed to the S&P 500, and they're not overly top-heavy. In fact, you can find equal-weighted indexes or ETFs, equal sector ETFs. You can buy individual ETFs that don't have as big of an exposure in the S&P 500. So I do like to have, even though I do own some S&P 500, I like to have other ETFs that make it so that I have a better balance, knowing that index is top heavy.
Okay. And the third part of that, do you expect the future stock market returns to be comparable to historical returns?
I can't answer that. I don't know.
No crystal ball.
Nobody. We had a question earlier that maybe he had a crystal ball. Nobody can tell you that. Nobody knows where we're going to be in a year from now. But if you're a student of market history and the U.S. economy, we know we push forward. So I'm a big believer of reversion to the mean, meaning that what we've seen over 100 years will continue to play out over time. So I don't know if the market will be up 9 or 10% in any given year, but I still believe over time, and this is why I still invest and believe in it, is that I think our average returns will still be there as long as we're in the game for long enough.
How many times a day do you get that question from clients?
I don't know. Most people do ask that. Well, how are we going to do this year?
Yeah. Okay. This one came in from Patir in New York. Question for Wes. I'm 35, married, and we both started maxing out our Roth 401k contributions this year. We also max out our annual HSA contributions and invest the funds. Both the Roth 401k and HSA investments go entirely towards a Schwab Target Date fund. Target Date fund.
Schwab Target Date Fund.
The 2055 specifically.
2055. That's way out there.
Is the diversification in these funds enough to keep us covered as we save towards retirement, or is funneling 100% of our retirement investments into a single target date fund a bad idea?
The short answer is it's totally fine. I think it's a good solution for a lot of folks. I'm not saying this particular fund, but like most target date funds, this one, if you're going out 25 years or 30 years, 2055, the target date fund will be heavily weighted towards stocks. I think the Schwab one is probably 93% in equities and the rest is in fixed income. So it's just a small amount. So we have a little bit of dry powder, but mostly towards equities. And he's 35. And it's U.S. and it's international. It's small cap. I believe there's different sectors. Actually, I think the way these work, these target date funds are funds of different ETFs for the different sectors. So it's almost like a fund of low-cost ETFs. So I'm not commenting whether it's a good or a bad investment. I'm just saying that almost any target date fund for somebody that young and 35, that's appropriate. It's appropriate. It's super diversified. If you look and see just any one of those individual ETFs that are stock-based are super broad, 3, 4, 5, 700 different positions. So we have a lot of diversification within each sliver of that overall pie chart. Now, the only time I really have problems with target date funds, or my main issue, is that if you were to be in one of these target date funds that's a 2025, this year that we're in, and this is your retirement year, many of them are 60% in bonds. So you're starting out this retirement journey, which, God willing, is another 30 years. I think way too few, I think with too little exposure to equity markets, which are really our inflation fighting elixir. Bonds can keep up with inflation, and they should over time. Equities are there to outpace inflation so we can give ourselves a raise. So in these early stages, you want to be mostly equities anyway if you have the risk tolerance for it. But I run into issues with target date funds when I'm getting close to that retirement date. I think they can get overly conservative for most people, not everyone.
All right. That does it for us.
That was a three-parter.
That was a three-parter.
No, the one before
the
that
one
was
before
three
it
parts.
was. Yep.
They're all running together, but they're all really cool questions. And I think the reason I've always liked doing this, Chris, is that even though you don't have the question and you're listening, it might pertain to you in some way. Mm-hmm. And I think when you're hearing other people that are having a struggle or a question or you're in a financial quandary and we're working through that, I think people can relate to that. And I think that's why these can be helpful.
Absolutely. And again, if you have a question, go to clark.com/ask. And thank you for joining us today. We hope you have a great rest of your day, and we'll see you on next week's Ask an Advisor.